Are you new to investing? Do you want to get started with a brokerage account? What this video is going to do is walk you through the process of, first off, opening a brokerage account. But on top of that, at the end of this video, you will know terms that can help you invest month after month after month. You don't need a ton of money to do this. You can do it with as little as $25. We're going to teach you what fractional share investing is. We're going to teach you what dollar cost averaging is. We're going to teach you a little bit about ETFs, and we're going to teach you about compounding interest. All so that $25 that you're looking to start to invest month after month after month can pay huge dividends for you over a 2-year, 5-year, 10-year, 20-year, 30-year time frame. Let's get started. By the end of this video, if you follow exactly what I tell you from here on forward, $25 over a 30-year period can turn into hundreds of thousands of dollars. I'm going to show you how to do it. Probably the hardest part of this whole thing is to get yourself an account open, fund that account month after month after month, so that $25 gets pulled from a checking account into the account and then invested. Unfortunately, you cannot fund an account with a credit card. It has to be a debit card or savings account. Now, I'm going to recommend 4 different brokerage firms. You can go do your own research, but I recommend Fidelity, Charles Schwab, Robinhood, or TD Ameritrade. Your next course of business is, what do I invest in? And what I'm going to recommend, and what also Warren Buffett recommends, is if you don't know exactly what you're doing and you're new to this, put the money into an ETF, an exchange traded fund that mimics the S&P 500. Recently, Forbes came out with a list of 6 ETFs that are your best bet to mimic the S&P 500. Let me give you the list. You do with it as you wish. I'm not here to give advice. Do a little bit of research, but I've given you some of the information about the total return, the ticker of each fund. You can use all 6 if you want. If you want to use just one, use one. If you want to completely diversify, use all 6. But unfortunately, there is what's known as over-diversification, and having 6 funds that mimic the S&P 500 might be the definition of over-diversification. Now, Warren Buffett famously had a bet in 2008, a 10-year bet against a hedge fund, and basically said, I bet you $1 million that over the next 10 years, if you just put money in the S&P 500, that will beat anything you can do with constantly investing in and out of individual stocks, individual companies. The S&P 500 will beat you. And what happened is he won. And he won the $1 million from the hedge fund. And the ETF, or the tracker of the S&P 500, beat the hedge fund, and actually beat it by a lot. The hedge fund manager returned 36.3% over that 10-year period minus fees. Now, the S&P 500 fund, which he said would beat that hedge fund, invested, again, let me get this right, 125.8%. So it more than doubled in that same period of 10 years. Now, let's hope that that same 10-year period happens from the day you open this account to 10 years from now. I can't promise that. I don't know. If I knew that, I wouldn't be making videos on YouTube. But it did well, and historically, the S&P 500 usually goes up in a 10-year time frame. I'm sure your next question is, What are the fees involved in opening these accounts? And again, that's why I recommend the 4 that I did, because there are no fees on these accounts to do what we're trying to do today. So once the accounts open up, once your checking account is tied to this brokerage account, you can have the account set up so that $25 on whatever day a month you want the $25 to go in gets deposited into the account. The next day, you can set it up so that that $25 automatically gets invested into whatever investments you have set up. Another thing you might hear of an awful lot is dollar cost averaging. And what's dollar cost averaging? One of the great things about dollar cost averaging is in the beginning, you really don't care if the stock is up or down. If you're in it for the long haul, you're buying shares. Maybe one day the stock said $350, and the next month the stock's at $340. Now you're buying the stock on sale for $340. Maybe the month after that, the stock's up to $360. So you're buying a little less. The next month it's down to $320. So you're buying a little bit more. And this continues on month after month after month after month after month. Over the long term, hopefully, you buy stock continually and it continues to go up year after year after year. You're not concerned about individual price movements day to day, month to month, even year to year maybe. Go with the example I've given you, and you've taken $25 and you're investing in this fund VOO that mimics the S&P 500. Now each month, you're going to go out there. So for example, on 12/1 of 22, this stock opened at $375.87. Again, you're only investing $25. You can't buy a full share of this. But what they're going to do is they're going to basically divide the $25 by this $375.87, and they're going to buy a small fraction of a share. And again, you're going to do this over and over and over and over and over, month after month after month, until you no longer have fractions, but you have full shares, and you continue to do it over and over and over, get more shares and more shares and more shares and more shares. So in this case, I put together something that 1, 2, 3, 4, 5, 6, 7 months. So you did it from 7 months, starting the beginning of the end of last year, and you did it up until 6/1/23. You put in for 7 months $25, which is $175, and you bought 0.4704 shares. You'll see this month after month after month after month in your account, and you'll log in. You'll say, "Oh, I have 0.4704 shares. Great. Let's multiply that out by what the share price is today, and that's the value of the account." It's fairly simple. And again, these 4 accounts that I've given you all do fractional share investing. So you don't have to buy a full share. You don't need $384.20 to make this happen. The 4 accounts that I gave you that you can use to open up your brokerage account, they all offer dollar cost averaging and fractional share investing. So I put together this little example here. Now after you have everything set up, you have the account set up, you basically have the $25 coming over month after month after month. Let me show you the power of compounding interest. And we said we're going to start out with $25. And we said we were going to deposit $25 a month. We're going to say that the S&P 500 returns 12% a year on average. Again, some years it might be negative. Some years it might be positive. Some years -5, some years positive 22. But on average, Looking back, the S&P has returned around 12% per year. Now, say you do this for 5 years. This is what happens. You can see you have $2,087, but you only put in $1,500. So you made $562 by basically doing nothing. By basically just going out today, setting the account up, setting up a payment so that $25 comes over, and setting up an investment that happens the day after that money comes in. It's fairly easy. You just set it and forget it. Now, let's say we do this for 10 years. You can see after 10 years, you've only put $3,000 in, but you've made almost $3,000. You made $2,800, again, by doing nothing. You're sitting on your couch having $25 go into this account month after month, year after year. Now, if you do this, say you're a young kid and you're just out of college or you're just out of high school, or you look back to one of the videos I did where you open an UDMA account with the help of your parents and you start super early. But say you roll this out to 30 years. Like I said earlier, if you do 30 years, you're looking at over $88,000 in investments, or total. You're looking at $88,000 for an account balance. Again, you only put $9,000 in of your own money over 30 years, and it's made you over $80,000. Now, again, maybe let's get crazy, and let's say that you want to put in $100, and you want to do that for, let's say, 15 years. Look at that. You're going to end up with $50,000 if you do $100 for 15 years. That's not bad for just setting and forgetting it. Now, if you do it for 30 years, you're making over $350,000. Again, a lot of these YouTube videos say, okay, start with 1,000 and you're going to end up with 2 million in the account. Tell those people to give me a call because I don't know how you do that. This is what I know what to do. This is what Warren Buffett knows what to do. Little by little by little, continue to invest year after year, month after month, and this is where you'll be in 30 years. An account value of over $350,000. And again, you only dropped in $36,000 over that 30-year period. It's a fairly impressive stat. Now, maybe you just don't want to buy one ETF and put $25 in it month after month after month. Maybe you want to spread yourself out and buy individual stocks. This is what you can do as well. This is the power of dollar cost averaging. Like if you want to buy Tesla, Google, or Alphabet, you want to buy Facebook or Meta, you want to buy Apple, you want to buy, you name the company you want to buy. You don't necessarily have to have the full dollar amount to buy one full share. For example, Robinhood, you can buy as little as $1 of that particular company. I know at Schwab, you can buy as little as $5 of that particular company. So again, do the math. At Robinhood, you could buy 25 individual stocks or 25 individual ETFs. At Schwab, you can buy 5 different stocks or 5 different ETFs each time you deposit the $25 in. Be careful how you do this, because if you buy individual stocks, you're ramping up your risk level. If you buy a fund that tracks the S&P 500, looking back over the last 20 years, it's a fairly solid investment. There's never been a time over a 7-year period where you lost money doing that. Now, I can't say that for individual stocks. You've heard of a couple of banks recently completely go out of business. So if you had money in those banks, you would have lost your entire investment. That's an exception, not the rule, and it ramps up your risk level when you start buying individual stocks. You do as you see fit, and by ramping up the risk level, potentially you can make more, but potentially you can make less. And I hope this little tutorial helped out. What I need you to do now is go out, open an account, link the account to your checking account, move $25 over month after month after month, and leave a comment in 6 months. Tell me how you did. I'd love to hear. Have a great day.